Breaking news: UK households with £10,000 in the bank could face a shock from HMRC. Here's what you need to know. Hey everyone, and welcome back to the channel. Today, we're diving into a financial update that could have serious implications for millions of people across the UK, especially those with money saved in the bank. If you've got £10,000 or more sitting in a savings account, you could soon face unexpected tax consequences from HMRC, and you might not even realize it until it's too late. So, what's going on, and how can you stay on the safe side? Let's break it down. First off, every UK resident gets a standard tax-free personal allowance, which is currently set at £12,570 per year. This allowance applies to all forms of income, whether it's your salary, pension, or even interest earned from your savings. On the surface, that seems like a pretty generous allowance. But when it comes to interest from savings, there are extra rules you really need to understand. This is where the Personal Savings Allowance comes in, and this is what catches a lot of people off guard. If you're a basic rate taxpayer, meaning you pay 20% income tax, you're allowed to earn up to £1,000 per year in interest from your savings completely tax-free. That sounds reasonable, right? But with interest rates on the rise and some savings accounts now offering around 5%, it doesn't take much for you to hit that limit. In fact, just £20,000 in savings at 5% interest would generate £1,000 in interest annually. That means anything above that, even by just a few pounds, becomes taxable income, and you may find yourself having to declare it to HMRC. Now, if you're in a higher tax bracket, things get even tighter. For higher rate taxpayers, those who pay 40% income tax, your personal savings allowance is slashed to just £500 per year. That means with a 5% interest rate, you only need £10,000 in savings to hit that limit. And if you're fortunate enough, or perhaps unfortunate enough, to fall into the additional rate taxpayer bracket, paying 45% on earnings over £125,000 per year, then here's the kicker: you don't get any savings allowance at all. That's right, all the interest you earn from your savings is taxable. This is where people get caught out. Many savers assume that because they're only earning a bit of interest, it doesn't count. But with today's higher interest rates, even modest savings can quickly cross those thresholds. And HMRC does track this, particularly with digital banking systems that automatically report interest earned. But don't worry, it's not all doom and gloom. There are some exceptions and lesser-known rules that can actually work in your favor, especially if you're a low earner or part-time worker. Let's talk about something most people have never heard of: the starting rate for savings. This is a special allowance for people with low earned income. If your income from work or pension is below £12,570, you may qualify for an additional £5,000 of tax-free interest on top of your regular personal allowance. That means you could earn a total of £17,570 tax-free, as long as your income is low enough. Here's how it works. If your total income is under £12,570, the full £5,000 starting savings allowance applies. But for every £1 you earn above £12,570, you lose £1 of that £5,000 allowance. So, for example, if you earn £13,570, your starting savings allowance drops to £4,000. At £14,570, it drops to £3,000. And once you reach £17,570 in income, the allowance disappears completely. This rule is particularly helpful for pensioners, students, or part-time workers who rely on interest income to supplement their finances. It's also something you can plan for in advance. For example, by reducing your taxable income through pension contributions or charitable donations, you may be able to regain some of that allowance. So, what does all this mean for you? Well, it's a wake-up call. If you've got £10,000 or more sitting in a savings account and you haven't been keeping track of the interest it's earning, you could be crossing the line into taxable territory without realizing it. Now, it's not about being punished by HMRC, they're simply applying the tax rules that already exist. But what it does mean is that you could end up paying tax on savings that you assumed were safe. And if you don't report it correctly, you might even face a fine or investigation down the line. But don't panic, there are smart ways to manage this. One of the most effective strategies is using a cash ISA or stocks and shares ISA. These allow you to earn tax-free interest, no matter how much income you make. For the 2025-26 tax year, the ISA allowance is £20,000, and that interest is completely shielded from tax. So, if you're close to your savings allowance or just want peace of mind, moving some of your savings into an ISA could be a smart move. Another useful tip? Spread your savings across multiple accounts. Some banks offer higher interest rates on smaller balances, so instead of keeping everything in one place, shop around for the best deals. Comparison websites are a great place to start. Also, don't underestimate the power of compound interest. Even small balances grow faster than you think when interest is paid monthly and added back into your savings. But as your balance grows, so does your tax exposure. That's why keeping an eye on your interest earnings is more important than ever. And don't forget to track your interest. Most banks now provide annual summaries, and some even break down your interest earnings month by month. It's worth keeping an eye on this so you're never caught off guard. It's also a good idea to speak to a financial advisor if you're unsure about how these rules apply to you. They can help you optimize your savings, reduce your tax burden, and make sure you're not missing out on allowances you may be entitled to. Small changes in how you save can lead to big differences over time, whether that's switching accounts, choosing better interest rates, or just understanding how tax rules work. And here's a key point many overlook: tax doesn't automatically come out of your interest, so if you go over your allowance, you are responsible for reporting and paying what you owe, usually through a self-assessment return or an adjustment in your tax code. Failing to do that can result in fines or penalties, even if the mistake was unintentional. So, to recap, basic rate taxpayers can earn up to £1,000 in savings interest tax-free. Higher rate taxpayers only get £500 tax-free. Additional rate taxpayers get no allowance at all. Low earners can benefit from the starting rate for savings up to £5,000 extra tax-free, depending on income. ISAs are your best friend for tax-free interest up to £20,000 per year. And always track your interest to stay on the right side of HMRC. If you found this video helpful, do me a quick favor, hit that like button and share this with someone you know who has money saved up. You never know who might be unknowingly earning taxable interest right now. And of course, for more practical financial tips, breaking money news, and smart saving advice, subscribe to the channel and hit the bell icon so you never miss an update. Thanks for watching. Stay informed, save smart, and I'll see you in the next one.